Hi, this is Dr. Welcome to this week's presentation. I'll go over the stocks selected for this week and what the analysis is. Okay, let me first share my presentation. Okay. All right, so the first thing we do is we will go through the disclaimer, which I had to always say, which is stock market investing is risky, and what I show you here and what my analysis shows you here is for educational purposes, and the final decision is yours. Okay, so let's first talk about what happened last week in the market. So last week on Monday and Tuesday, the market was just hanging in there because they were waiting for the FOMC decision, the interest rate decision. So it was kind of flat Monday and Tuesday. On Wednesday, around 2 o'clock, the Fed came and it released a statement, the meeting statement, and there was few things in the release that looked bullish or dovish about the interest rate. So the market took it very positively and started going up. But then the press conference started, and Chairman Powell came out and said things that were very, very hawkish. He said that the interest rates are going to be high for a long time, higher than what they thought in September meeting. And so the market did not like it and took a downward drift. Then later on Thursday and Friday, it stabilized. But on Friday, there was one more news, which is about China. And China is extremely important for certain sectors in the market, like the materials, like some of the consumer products. And the rumor was China would go slow on the COVID-0 policy. That is, they would relax the COVID-0 policy. And some stocks, really went up because of that. And so basically, those were the factors that drove the market last week. But I think the market is still in the bear market territory, and the interest rates will drive how the market behaves for the next few weeks, next few months, and by which time people will know what is the terminal rate. Today, it looks like it's going to be around 5 or 5.25%. And then they'll also get hints of how slow the increases might be in December and January. And at that point, the interest rate becomes less important, and the actual earnings become more important. And in January, February, there'll be lots of downward revisions, and as a result, the market may go down. So the market is still hasn't reached its, I think, the absolute bottom for this cycle. It probably is going to happen somewhere between now and end of February. But there'll be plenty of opportunities for us to look at stocks where they may be still in the valley, and we go in this valley and we pick up the stocks we think are good stocks. Okay, so this week we'll look at 3 stocks, and one of them is in the technology sector, which is CDNS, and Cadence, which is in the semiconductor business. And specifically, it's a company that builds tools for semiconductor design. And right now, the stock, or at least as of November 3rd, the stock was $142. And year to date, it had lost 43%. The second one I want to talk about is the consumer staples stock, specifically in the personal care sector, which is the Estee Lauder. They're in skincare, makeup, and that type of thing. And their price on November 3rd was $193, close to $194, and they have gone down a lot, more than 47, close to 48% year to date. And the last one I want to discuss is the Zoetis, which is in the healthcare, which is in a subsector, which is the animal healthcare, taking care of animals in the farms as well as pets, especially pets. And people do spend a lot of money on their pets. And this is a stock that has gone down a lot, 46% year to date. And there's some reason. There are always reasons why stocks go down, but you need to evaluate those reasons and see if those reasons are temporary and what is the outlook for the next 6 to 12 months, and then make a decision on whether it's a good investment or not. Okay. All right. So CDNS, let's look at the performance for the last 12 months. For the last 12 months, it has gone up and down a lot. And one of the reasons is this stock is very, very sensitive to interest rate expectation. Why is it? It's a tech stock, it's a growth stock, and it has a very high P. Even today, with the values having come down tremendously, the P is 33. So you can see it's a very high P stock. So as I said, it is in the EDA software and tools, electronic design tools, and it helps semiconductor companies and electronic systems. For the past 12 months, down 17, the high was 194, the low was 132, and the close on 11.3 was 142. It doesn't pay any dividend. It takes the money and reinvests in its own business, which is good. Now, the consensus for the next year is $4.4. So that's where, things get, somewhat suspicious, because we know the market is slowing in terms of semiconductor demand. The overall economy is slowing. So when the semiconductor companies are not making as much revenue as they thought, they may not, buy as many tools as, analysts are expecting today. So the earnings will come down. In fact, CDNS itself has hinted at that. And so over the next few months, you will see revisions downwards. Okay. However, people are very bullish on this stock, and the sell side target price is still very high, $180 to $210. Okay. So let's do a quick analysis on this stock. So as I said, the consensus EPS today on the sell side is $4.4. So there'll be at least 10% downward revisions in January. And I expect that to be around the new consensus to be around $4. Now the current P is around $33 for the price we have. And however, after the revisions, the P range will move from 30 to 45. 30 in the initial parts of the year, in the January, February timeframe, and 45 as the interest rates start coming down and the economy seems to start coming back up. So with this dynamics, the low for the next 12 months is going to be around 120, and the high is going to be around 180 compared to what was the low and high in the past 52 weeks, 132 and 194, not too far away from where it was. Okay, so what does it mean? If you're anywhere in the vicinity of 120, it is a good buy. So I would say, I wrote here less than 125 is the buy zone. I would even say it's less than 130. If it reaches 130, you should seriously consider this stock. And if you hold on to a year, it could hit 180, which is, a good raise, maybe even more than 40%. So that's a good stock to consider. Okay. The second stock I have here is Estée Lauder. So Estée Lauder has three factors driving its price down. One is China. They're very big in Asia and specifically in China. And with China lockdowns, the zero COVID policy lockdowns, they're not selling a lot. They also have supply constraints, supply management constraints. And since they get a lot of the revenue and profits from outside the United States, the dollar strength is also bringing the stock down. And within the United States, the work from home trend has also affected their sales. So these are all driving their price down. However, going forward, a lot of these things will start reversing. People will start going back to their offices. China will eventually open up. In fact, last week, there were rumors that China might loosen their zero COVID policy. And one of the reasons was they had started allowing importing BioNTech vaccine for the expats who lived in China. Now, the reason China is having a COVID zero policy is their vaccine is not very good. its efficacy or effectiveness is not as good as, say, the Pfizer or the Moderna one. So because of that, they have not really achieved herd immunity. And so when they said they are going to allow importing foreign vaccines, people thought maybe they will import it on a mass scale and they will reach herd immunity and then it opens up. So that was a wish. But apparently the Chinese government came out and said they were not going to loosen up the zero COVID policy. So let's see what China does. But that will eventually, change sometime in 2023. The interest rates will also stabilize in 2023 and supply chains will also get better. So things will change in the next 12 months for Estee Lauder. So right now in the 12 months, the low high is 186, 374. So compared to their high, they lost more than half of their value. The recent close was 193, and the guidance for 2023 they have brought down, on their own 5.25 to 5.4 versus what the analysts were thinking, which was 7. Their current PE is 36. So what is the price target? We are saying it's around, the recent price target. This is not my price target. This is the target price from analysis 201, 209 to 303. So let's do some quick analysis here. So the consensus the EPS rather, is around 5.3, which is actually their own guidance now, right? So which is good. So it's not going to come down a lot. So maybe it will come down to $5, And the current PE is around 36. And the forecasted PE over the next 12 months, 35 being, in the next 3 or 4 months, when things are still shaky in the market. And then 50 being, their usual high-end PE towards the end of the year. And that takes you from $175 to $250. So this stock, I would say, is a buy if it goes to 200 or below. In fact, it had gone, below 200 a few weeks ago, actually 1 week ago. So that was a good time to buy. But anytime it goes below 200, this stock is a buy. It's a growth stock. They also pay a nice dividend, and more than that, they increase the dividend, every year, by a good percentage point. So this stock, when it is less than 200, is something you should consider. Okay. So the last one we want to talk about is ZTS or Zeotis. As I said, it's in animal healthcare business. This stock has also been down considerably. And in fact, their high was around 250. And then they have come down to 124 post earnings, the recent earnings report. In fact, they've had 2 quarters of disappointing earnings. So that, has driven their stock down, because whenever a growth stock gives bad earnings, it's really bad for the stock. However, the pet care business, the pet health business, is a growing business. People will spend a lot of money on pet care, and the company should do better. Their supply chain management problems will be resolved, and analysts think today, the sell side analysts think, the target for them is around 170 to 250 over the next 12 months. So which is still, very good growth prospect according to analysts. But let's do our own analysis here. So their consensus EPS after their earnings shortfalls has been around 4.8 to 4.9. It may still come down a little bit. It may be 4.85, let's say. And then the PE currently is around 27. And I don't think the PE will go down further. The reason being, they've already come out clean even before the analysts started downgrading or revising their EPS estimates. So once they roll out, improved performance, the financial performance in the next few quarters, their P will pick up, will start trending towards their, the growth P they have shown in the past, which is around 37. So the low from this should be around 124 and the high should be around 180. So the low, has already been reached. They reached that after the third quarter earnings. So this stock, anywhere less than 135, I think is a good buy. And you can have more than 35% raise in the next 12 months. And if they really show good performance in terms of their EPS and their revenue growth over the next 12 months, it may even go further. It may reach even 250, their previous high, because this is a growing segment of the market and people want to own this. It's a defensive sector too. So there'll be a lot of funds will be after this once they start showing improved performance. So I would say right now, ZTS is a good time to buy. Okay. All right. So this is our analysis. So next week, we'll do a few more. And as I said, you can always, comment on the community sector and tell me which one you would like to get analyzed. And we'll go from there. Okay. Thank you very much. And I hope you subscribe to my channel. Thanks. Bye.